Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today I am going to be taking a look at AT&T and Verizon stock. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I will get the ticker on the whiteboard behind me and eventually I'll make a video. If it's a stock that's not in the S&P 500, I post those over on Patreon at the $5 per month tier level. I also have a $25 a month tier level on Patreon where I share a stock pick each week. I just look and try to find the best deal that I can in the market that week and share it. Usually those come out on Tuesday and Wednesday. So far it's been going really well. As always, this is not individual investing advice. This is just how I analyze stocks. So AT&T. I'm going to try to kind of incorporate a little bit of a bigger lesson, or, you know, it's really more of like a philosophical investing thing at this point. One of the primary, or maybe the primary reason I think that stocks can offer a superior value when it comes to investing is that they're shares in businesses, okay? And the higher quality businesses have the ability to pass on inflation to their customers. And then hopefully on top of that, they can grow as well. So there are this is why I like to have businesses that have like some real growth to them. One, it shows that historically they can pass those costs on. Two, it gives you the chance to compound over time, which is the other kind of really big advantage of having stocks compared to like bonds or something like that. So when you have a really slow growth company, it's kind of barely, for one, AT&T's is kind of barely doing that. Right? They've only doubled their earnings over the past 20 years, essentially. And they haven't, that's not much faster than inflation, which I'll show you in a second. But if you just look at the historical price performance and return, including the dividend, if you go to Fast Graphs, just go to it runs 20 years, right? So this is about 20 years. It's returned about 4.4% per year. Well, inflation's been, call it 3% a year. So 1.5% a year is the type of return that you're looking at if you bought it almost exactly 20 years ago. Now, if you happen to buy it kind of during this middle period, that 20 years ago was actually almost in a recession, then you're only getting the inflation rate, basically. So you get no return over 10 years. That's what you've got from AT&T. And part of that is because they pay out this big dividend. Right now it's 5%. The yield is. I don't know, I might be able to put the yield on here. Dividend yield. Boom. But at other times, it's been higher. Right before they cut it, it was at 8% when they divided up the company. They can't just cut the dividend because that would tick everybody off. They have to do some kind of M&A activity and pretend that they're not actually cutting the dividend. But some of these periods, like if you would have bought it back then, you would have been getting like a 5% yield. During this dip, you would have got a 7% yield, so pretty attractive, right? For the yield hunters out there. But the problem is when you can still lose money. Let's say you bought during this downturn, like right at the bottom, and you held it through today. Okay, you get a 6% per year return. And we've had 4% inflation a year. So you're getting a 2% real return, which it's just not very good. What's the point of like buying a stock if you're only going to try to get a 2% return? Why take the risk that comes along with it if that's all you're going to get? That's kind of my philosophy. So whenever I see something that has kind of this poor long-term performance, I pretty much just toss it aside and don't look at it much longer. You can also look at the earnings growth. So earnings growth over this time, 3.35%. So again, that's barely better than inflation. Inflation's been about 3% a year. So basically, you're not getting any return. The business isn't really returning any money. It's just holding steady. And the executives make a lot of money. They get well paid for not really performing. I mean, that's not totally uncommon, but for a business this big, and it's just not very shareholder friendly. I mean, what they needed to do was take that dividend and reinvest the money somewhere and try to grow the business if they can. If they can't, that's okay. But I want to go try to find. Now, if it yielded like 10% and it still was stagnant, okay, now you're actually getting some yield out of it. But even though 5 and 6% sounds like a lot, it's not when there's 4% inflation, So they're just not very good investments. A lot of utilities are like this too. They might have steady earnings, and right now the multiples have expanded a lot on these utilities. They're extremely expensive. I'm not going to go through all of them right today, but let's look at Verizon as well. So again, I'm just going to go back here, the beginning, almost exactly the same as AT&T, 4.5% return on average per year. Inflation's 3%. You're making 1.5% for 20 years. You're basically making nothing, right? Now, if a person wants to try to trade these for like some mean reversions, there's been a couple times you could have made 50% in a couple of years on AT&T. This was a pretty good little run for Verizon here, but the thing is, there's plenty of other stocks you could have bought during this time that actually would have grown and kept growing, and you could have made a lot more rather than trying. During the periods where these are kind of cheap, usually there's other stocks that are better deals. So just to kind of demonstrate this, and these guys have like nearly a 7% yield now, and I'm sure a lot of people are buying it for that. I would not buy it for that. If you take a look at the other major competitor, as soon as I can remember the ticker, maybe I need a space. I thought it was T-Mobile. I thought it was TMUS is what I thought the ticker was. There we go. Okay. T-Mobile. Okay. Earnings have been choppier. But they don't pay. Well, they just started paying a dividend this year. But historically, they haven't paid a dividend during all this time. And so they've been putting their efforts toward growth, like growing the business. I saw they just acquired like my fiber optic company that I use for the internet here, and so you can see it, and they're cutting all different kinds of deals all the time, trying to grow and expand their business for the future. That's really what you ultimately want. I am long this with a half position now that I just bought recently this year. If you look at the returns here, actually let's pick. Yeah, that's kind of a peak right there. Okay, I'm going to try to pick this high point here. So I'm not just picking like a recession bottom. And you go up here. Okay, now you're getting 10% a year return from basically a company that's in the same business. I mean, AT&T was in all kinds of other stuff, but Verizon is similar. And you could have gotten a 400% return instead of nothing. And that's kind of the difference between a business that's reinvesting and growing compared to one that's pretty content with just going nowhere. Or at least that's just what was happening. And it's hard for a business to grow when they're paying out most of their profits in the form of a dividend, and the people that are running it just don't really have the mindset of growth. So when it comes to stocks like AT&T and Verizon, I just avoid them. Every now and then I'll buy a utility if it gets like cheap, but it's just not the reason to own stocks. I can get a 4.5, well, more than that now, and between 4.5 and 5% yield on treasuries, short-term treasuries right now. Why try to get an extra 1% or whatever? Not even that. It's almost yielding the same as AT&T. And then you have the risk that you can lose your principal. They carry tons of debt, right? So the risks are just too high for the rewards. And it's really only investors that are focused on the dividends that are buying these stocks. And I mean, I think that cash is better basically than trying to do that, because at least you get some safety there. If I'm only going to get 1 or 2% above inflation, you might as well just have like short-term treasuries or something. So that's my thought on AT&T. I'm sure somebody wanted me to do a valuation on it. I'm not really going to, because if we look at earnings, it looks like they're going to be flat. I mean, I don't expect anything to change. Let's just put it that way. You might be able to get a 50% pickup on something like it just happened here, right? But outside of that, and it doesn't mean the stock price couldn't go higher, it's just not going to reliably do that, and it just doesn't have the profile of a growth stock of a growth business, not even just a stock. The earnings need to be growing. Earnings peaked like in 2018 or 2019, and they've never even gotten back there yet. So earnings are going the wrong direction. All right, thanks for asking about this one. Sorry for the lecture, but hopefully I don't know how else to kind of frame it sometimes. There's some stocks I just look at and then it's like, well, that's just not why I buy stocks, right? If you enjoyed this, if you found it useful, thought-provoking, hit the like and subscribe button. If you have a request, let me know. A lot of times I actually do valuation work on stuff, but this one I'm not going to. And I'll see everybody later.